Today, the US boom phase and what's next. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The future trajectory of the US market would largely determine the state of the global financial system over the next couple of years, partially because of the role of the US dollar and partly because of the sheer size and influence of the US financial sector. And it will potentially have a direct impact on Australia. So today we look at the latest data on the state of debt in the US corporate sector. And frankly, it's just not pretty. The chief economist at Moody's Analytics, Mark Zandi, penned an interesting piece suggesting that there is extensive risk-taking among US corporates as the business cycle moves past its zenith. There are some worrying similarities between corporate leverage lending now and the subprime mortgage lending of the last crash. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here is the link, and it's also in the comments below. The US business cycle has, he says, entered its boom phase. This is a period that typically comes closer to the end of the cycle, just prior to a recession. And it's characterized by robust economic growth, tightening labor and product markets, intensifying wage and price pressures, monetary tightening, and higher interest rates, all of which we can tick off. Another feature of the boom phase of a business cycle is extensive risk-taking somewhere in the financial system. This fuels the boom and is eventually at the centre of the subsequent bust. Subprime mortgage loans were the obvious culprit a decade ago. Runaway internet stocks that pumped up a stock market bubble were the problem in the early 2000s recession. And the savings and loan crisis incited the early 1990s downturn. Risk-taking is clearly on the rise in this cycle. The aforementioned overvalued asset markets and easier underwriting are testimonials, but it is unclear precisely what might do this cycle in. There has been hand-wringing that households may be overborrowing again, but this concern seems overblown in the US. Household credit growth is constrained with income gains and debt loads that have fallen sharply after the last recession and show no indication of rising. Debt service burdens remain low and personal savings rates look ample after recent data revisions. To be sure, he says, vehicle and retail card lenders were extending too much credit not too long ago, and credit quality eroded, but lenders have since upped their standards and delinquencies have peaked. Student loans are a problem, but not for the financial system, since the bulk of these loans are backed by the federal government. And student loans are thus a taxpayer problem, which could manifest itself in the next downturn by adding to the nation's fiscal problems. Policymakers will be under intense pressure to forgive and forbear on more of this. Worries that the nation's ballooning budget deficits and land load could do this cycle in are also overdone. They negatively impact growth as they push up long-term interest rates, but we are still a long way from US Treasury bonds losing their safe haven status to global investors. Municipal debt, however, is more of an issue, but while it will likely exacerbate the next recession, it won't be the catalyst for it. He says the most serious developing threat to the current cycle is lending to highly leveraged non-financial businesses. Across all businesses, borrowing appears manageable, The ratio of debt outstanding to GDP is about as high as it's ever been, yet this is a continuation of a long-running trend and reflects a broadening in the availability of credit to more businesses. The ratio of debt to business profits looks even more benign, largely unchanged since the early 1980s, abstracting from recession when profits are hammered. However, while businesses appear to be in good shape in aggregate, a significant number of highly leveraged companies are taking on sizable amounts of debt. And this is evident in the rapid growth of so-called leveraged loans, loans extended to companies that already have considerable debt. These loans tend to have floating rates, especially LIBOR plus a spread, with a below investment grade, let's say BBB or less ratings. Leveraged loan volumes are setting records, and loans outstanding have increased at a double-digit pace over the past 5 years to nearly $1.4 trillion. Businesses use these loans to finance mergers and acquisitions and leverage buyouts, followed by refinancing and to pay for dividends, share repurchases, and general expenses. Powering leveraged lending is demand from the collateralized loan obligations markets. CLOs are leveraged loans that have been securitized, and global investors can't seem to get enough of them. This is clear from the thin spreads between the CLO yields and comparable risk-free treasuries. Approximately 1/2 of leveraged loans currently being originated are packaged into CLOs, with CLO outstandings approaching $550 billion. To meet the strong demand for leveraged loans from the CLO markets, lenders are easing their underwriting standards. According to the Federal Reserve's survey of senior loan officers at commercial banks, a net 15% of respondents say they lowered their standards on commercial and industrial loans to large and medium-sized companies this quarter compared with the previous quarter. The only other time officers eased as aggressively on a consistent basis was at the height of the euphoria leading up to the financial crisis in the mid-2000s. Standards for loans to small companies have not eased nearly as much, since they are much less likely to be bundled into a CLO. Covenants on leveraged loans, restrictions on borrowers to ensure that they can repay their loans, have also deteriorated, according to Moody's Investor Service. The ratings agency Loan Covenant Quality Indicator has fallen to its lowest level in its 6-year history. Borrowers are negotiating greater flexibility to manage their balance sheets by moving or selling collateral, and they are increasingly able to sell collateral without using the proceeds to pay down their loans. It is becoming more unclear whether the collateral backstopping loans will be available in a bankruptcy. The easing in underwriting is also evident in the below investment grade or junk corporate bond market. The junk market hasn't kept pace with the surging leveraged loan market, but it is nearly as big, with more than $1.3 trillion in outstandings. Here as well, bond covenants have eroded substantially in recent years, according to the ratings agency, with the Moody's Bond Covenant Quality Indicator currently hovering near record lows. Considering the leveraged loan and junk corporate bond market together, highly indebted non-financial companies owe more than $2.7 trillion. Their debts have been accumulating quickly as creditors have significantly eased underwriting standards. As interest rates rise, so too will financial pressures on these borrowers. Despite all this, global investors appear sanguine, as credit spreads in the CLO and junk corporate bond market are narrow by any historical standard. Regulators are undoubtedly nervous. They issued guidance to banks to rein in their leveraged lending in 2013, but an increasing amount of the most aggressive lending is being done by private equity, mezzanine debt, and other institutions outside the banking system and therefore outside regulators' purview. Now consider that subprime mortgage debt outstanding was close to $3 trillion at its peak prior to the financial crisis. Insatiable demand by global investors for residential mortgage securities drove the demand for subprime mortgages, inducing lenders to steadily lower their underwriting standards. Subprime loans were adjustable rate, which became a problem in a rising rate environment as borrowers didn't have the wherewithal to make their growing mortgage payments. Regulators were slow to respond, in part because they didn't have jurisdiction over the more egregious players. It is much too early to conclude that non-financial businesses will end up the current cycle in the way subprime mortgage borrowers did in the previous cycle, but even so, while there are significant differences between leveraged lending and subprime mortgage lending, the similarities are eerie, and we could end up in a somewhat similar place. If you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by ringing that subscribe bell. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.